The secret to a consistently growing portfolio isn't just about picking the right stocks, but also about timing your moves with the market's natural seasonal patterns. Instead of following the crowd who keep pushing the same tired advice about investing in what you know, you need a more strategic approach. To get a better understanding, let's look at how the stock market has moved through 2024, and then we'll peek into what we might expect for 2025. Imagine taking the last 15 years of the S&P 500 performance data and compressing it all into a single chart. This will give us a very good idea of how the stock market tends to move throughout the year. But remember, the stock market is organic and alive, so while these patterns are guides, they're not absolute rules. Let's start with December, as the end of the year sets up how the following year tends to start. December is synonymous with strong moves up in the stock market, which can result in what is called the Santa Claus rally. It doesn't happen every year, but it pays to keep your positions open just in case Santa decides to deliver. Now, conventional wisdom tells us that January or February usually brings a correction, especially after a strong Santa rally. February in particular tends to be one of the weakest months historically. The data consistently shows February delivering negative or modest positive returns, with many analysts attributing this to the post-January effect cooldown and an earnings season lull. But 2024 threw us a curveball. Instead of pulling back, the market rallied about 10% from January through to March. The correction didn't show up until April, which is typically one of the stronger months. This perfectly illustrates why we need to be flexible in our approach and not rigidly bound to historical patterns. This is where understanding market dynamics becomes crucial. The S&P 500 had pushed through the significant 5,000 level between January and March. Following natural price action principles, we saw a pullback to retest this level as support in April, with almost a 6% decline. While social media was flooded with doomsday predictions, we knew better. This was just a healthy correction, not the market apocalypse many were predicting. Okay, so let me pause here for a second to emphasize something critical. During this April pullback, our social media channels were absolutely swamped with catastrophic predictions. These finfluencers were more concerned with generating clicks rather than providing accurate market analysis. It's a dangerous game they play with other people's financial future, and it's exactly why we focus on data and patterns rather than sensationalized headlines. By May, patience paid off. The market found support at 5,000 and rallied over 6% to new highs. This is why we tell our community to stay calm during corrections. They're natural and often lead to new opportunities. The mental fortitude to hold through these periods is what separates successful investors from the crowd. The summer months brought their own story. Between May and July, we saw a 7.5% climb before the market went sideways from July through to September. So why a sideways market over the summer months? Well, people go on holiday, traders are away from their desks, institutional money dries up, and so stocks settle into a lull period. This again is where patience comes in, and it pays to just leave positions open. This is your time to enjoy the summer months, go on holiday, spend time with your family, or whatever it is you choose to do. This year, July saw a notable 10% decline first before settling into its sideways market, and that was primarily due to big tech earnings struggles. But here's what many missed. While the heavy-weighted tech stocks dropped, many smaller stocks held steady or even gained. This divergence created fantastic opportunities for investors who weren't solely focused on the major tech names. The summer sideways market is actually a blessing in disguise. While day traders struggle to find movement in these low volume conditions, long-term investors can use this time to carefully analyze their positions and plan their next moves. Think of it as the market's way of giving you a breather. Use it wisely. Now, September and October bring their own unique challenges. Historically, September has been the worst performing month of the S&P 500, with negative returns occurring more than 50% of the time since 1928. Institutional investors rebalancing portfolios, uncertainty ahead of Q4 earnings, and the return of full trading volumes after summer vacations all contribute to this pattern. In 2024 though, we saw a divergence from this pattern. Instead of the typical September weakness, the S&P 500 rallied 3.5%, with the correction coming in October instead. This shift was particularly interesting because it coincided with the pre-election positioning, as markets began pricing in various political scenarios. The market then rallied about 7% from the October low to new record highs, boosted by Trump's re-election. This post-election rally demonstrated once again why it's crucial to stay invested through periods of uncertainty. The biggest moves often happen when least expected. Looking ahead to 2025, we need to consider multiple scenarios. While the S&P 500 has surged about 75% from its 2022 lows, we could see continued momentum towards 7,000, a sideways market, or even, though unlikely, a bear market. Smart investors prepare for all scenarios while positioning themselves based on current market conditions. Let's break down what we might expect in 2025 if the bull market continues. First, we'll be watching December 2024 closely for signs of that Santa Claus rally. A strong finish to the year often sets the tone for Q1. Then we'll be particularly vigilant in January and February, watching for signs of that typical early year correction. The spring months, March through May, historically bring some of the strongest returns of the year. This is when institutional money often flows most heavily into the market, and earnings season tends to be particularly impactful. Summer will likely bring another period of consolidation, but remember, these quiet periods are often when the best setups develop. Now, here's how to apply this knowledge practically. During up periods, we buy new stocks and compound winners. This means not just holding positions, but actively adding to them when conditions are favorable. During corrections, we exercise patience, potentially cutting weaker positions while holding onto stronger ones. When the recovery comes in, we start adding new positions again. This approach works best when combined with smart stock selection and position sizing. Simply buying any stock during favorable periods isn't enough. You need to focus on stocks with strong historical performance and solid technical setups. To learn how to pick top performing stocks, watch this video where I explained the methodology I have used to grow my portfolio by an average of over 30% per year for the better part of a decade.